All right, today we're going to deconstruct the biotech company ADMA Biologics. We're going to give it a full financial checkup, look at its health, its performance, and what the future might hold, all by digging into what the data really tells us. But first, you got to ask, how do you actually know if a company is healthy? Well, the best way to think about it is like a doctor's visit, but for a business. We're going to look at its key metrics, the financial vital signs, that really tell the story of its stability and its potential. So, for our first checkup, we're looking right at the company's foundation. Is it built on solid rock, or is it more like shifting sand? And that all comes down to its current financial health. And the first vital sign we always check is debt. How much does the company owe? And more importantly, how well can it manage those debts? This one thing right here reveals a ton about its risk profile. And right away, ADMA's first vital sign looks really strong. This number, 18.4%, that's its debt-to-equity ratio. So what does that mean? Basically, for every dollar of value the owners have in the company, there's only about 18 cents of debt. For a biotech company, which, often has to borrow a lot to fund all that research, that is a very, very healthy and manageable level. But honestly, that number doesn't even tell the whole story. To see the real transformation, you have to look at where they were just 5 years ago. A staggering 125.6%. They actually had more debt than equity. To slash that number so dramatically, wow, that shows some incredible financial discipline. Okay, so we know they don't have a lot of debt, but can they handle what they do have? That's where this thing called the interest coverage ratio comes in. Just think about your own finances. Does your monthly income easily cover all your bills, or is it a bit of a struggle? Well, for ADMA, it is no struggle at all. Their earnings cover their interest payments nearly 20 times over. That's just an incredible buffer. It means there's an extremely low risk of them ever running into trouble with their lenders. So our first diagnosis is confirmed. Financially, these guys are on very solid ground. A solid foundation is great, of course, but that's just the starting point. The truly exciting part of this story is the growth that's been built right on top of it. So let's take a look at where this company has come from. I mean, just look at this. Over the last 5 years, ADMA has grown its earnings at an average rate of nearly 65% a year. To put that into perspective, the rest of the biotech industry averaged just under 23%. They are absolutely leaving their industry in the dust. And this timeline, it just shows that incredible journey in even more detail. Back in 2022, they were losing $66 million. A year later, they cut those losses by more than half. By mid-2024, they flipped to a $35 million profit, and by the middle of 2025, that profit is expected to surge to over $200 million. I mean, that is a textbook turnaround story. Okay, so rock-solid balance sheet, explosive past growth, check and check. The big question now is, can they keep it up? Let's see what the experts, the people who follow this company for a living, are forecasting. And the analysts are projecting strong, consistent growth pretty much across the board. They expect earnings to grow over 23% a year, revenue to grow over 20%, and earnings per share to grow right alongside them. This tells you it's not a one-trick pony. The growth is expected to be really broad-based. And just to put that 23.3% growth in context, it's way higher than the forecast for the entire U.S. market, which is sitting around 15%. So the expectation is crystal clear. They're set to continue outperforming. So all this strong data leads us to the final and I think the most interesting question, the valuation puzzle. With such a positive story, what's the stock actually worth? Is it a bargain, or is all this good news already baked into the price? This is it, right? This is the million-dollar question, or in AMAD's case, the multi-billion-dollar question. Let's see what the numbers tell us. Okay, so one common way to value a company is to project all its future cash flows and then calculate what they're worth today. And using that model, ADM's fair value is estimated at over $56 a share. Compared to its recent price, that suggests it could be almost 70% undervalued. But that's only one way to look at it. And this, right here, is why valuation is such a puzzle. Let's look at it from a completely different angle. Here, we're comparing ADMA's price-to-earnings ratio, or PE ratio, to its direct competitors. ADMA's PE is 19.7. That means you're paying about $20 for every $1 of its current earnings. But look at the average for its peers. It's just 10.4. Suddenly, from this perspective, ADMA actually looks expensive compared to its rivals. And there's the puzzle. You've got one metric, one that's focused on the future, saying it's a deep bargain. And you've got another metric focused on right now, saying it's expensive. So which one do you trust? I guess that depends on whether you're investing in the company it is today or the company it's expected to become.
Okay, so after that pretty deep dive, let's step back for a second and put all the pieces together. Let's recap the key takeaways.
Here is the whole story in about 30 seconds. First, it's financial health. Rock solid. They've slashed their debt and can easily cover their payments. Second, it's past performance. Explosive, with that dramatic turnaround to profitability. Third, it's future growth. Well, analysts expect it to keep outpacing both its industry and the broader market. And finally, the valuation. It's a complex picture, a potential bargain based on its future promise, but looking pricey compared to its peers today.
And that leaves us with one final thought. The data shows a company with an incredibly strong financial foundation and a really promising growth story. But the market is sending these mixed signals on its price. So the question for you is, when you see strong fundamentals clashing with a complex valuation, what matters most, the past, the present, or the future?